Let me start with a question that every serious silver investor should be asking right now. Do you truly understand why silver is behaving this way? You are looking at your portfolio, watching the daily charts, and feeling the deep, agonizing pain of watching an asset with unprecedented structural demand suddenly experience a dramatic and seemingly inexplicable pullback. It feels like a massive mistake, doesn't it? You look at the macroeconomic data, you see the persistent inflation eroding your purchasing power. You read the reports detailing massive, unyielding industrial deficits, yet the price action on your screen remains entirely paralyzed, leaving you with nothing but mounting fear and profound regret. The mainstream financial media will eagerly tell you that silver is a useless relic of the past, that the relentless noise of the daily market fluctuations proves once and for all that it is no longer a viable hedge against economic ruin. They actively want you to panic. They want you to capitulate. But I have spent decades analyzing these exact macro conditions, scrutinizing the hidden plumbing of the global financial system, and I am telling you right now with absolute certainty that what you are experiencing is not a fundamental failure of the asset itself, but rather a highly predictable, mathematically driven mechanical suppression deliberately designed to shake out weak, emotional retail investors right before the smart money initiates a massive, historic wealth transfer. This is an orchestrated trial, a brutal psychological test of your conviction and resolve. And today, I'm going to give you the historically proven, exclusive insider knowledge that will completely change how you view this current market chaos and empower you to take back control. We must systematically break down the mechanical explanation of why silver drops so violently in these specific environments, an explanation that unfolds in 6 distinct, inescapable steps. Step 1 begins with a sudden, unexpected shock to the broader financial system, usually triggered by a severe liquidity crisis, a sharp contraction in credit availability, or a sudden spike in interest rates that destabilizes the debt markets. When this critical macro condition materializes, large institutional portfolios instantly begin to bleed capital at an alarming rate. Step 2 follows almost immediately, as these highly leveraged institutions, hedge funds, and investment banks face massive, crippling margin calls across their broader equity, real estate, and debt positions. To meet these urgent margin calls and avoid immediate insolvency, they are forced by their prime brokers to liquidate their most liquid, profitable assets, and historically, precious metals like silver and gold are exactly what they sell first. Not because they genuinely want to offload them, but because they absolutely have to in order to raise immediate cash. This desperate scramble for liquidity creates the initial dramatic price drop that terrifies the retail market. Step 3 is the relentless cascade of algorithmic and high-frequency selling. As the price of silver crosses critical downward technical support levels, trend-following algorithms and automated trading programs instantly detect the weakness and automatically trigger aggressive short positions, pouring gasoline on the fire and exponentially exacerbating the downward momentum without any human intervention or fundamental reasoning. Step 4 introduces the devastating psychological capitulation of the retail market. The average everyday investor watching the unthinkable happen to their supposed safe haven asset succumbs entirely to fear and begins to panic sell at the absolute worst possible moment, thoroughly convinced that the fundamental macroeconomic thesis has somehow permanently broken. They simply cannot absorb the extreme volatility and they surrender their positions at a massive loss. Step 5 represents the absolute peak of this mechanical suppression. A surreal environment where the paper derivatives market completely decouples from the actual physical reality of the underlying commodity. The massive, unprecedented influx of paper short contracts created by the algorithmic trading desks creates an artificial, completely fabricated abundance of supply, driving the quoted spot price down to ridiculous levels that make absolutely no logical sense when compared to the severe physical tightness currently being reported at the sovereign mints, the global vaults, and the industrial depositories worldwide. Finally, step 6 is the quiet, stealthy accumulation phase executed by the true structural buyers. While the emotional retail market is screaming in pain, paralyzed by fear, and liquidating their physical holdings in absolute disgust, the smart money, the central banks, the massive sovereign wealth funds, the billionaire family offices, and the colossal industrial giants who desperately require physical silver for yield-bearing instruments, advanced electronics and green energy technologies begin to aggressively and relentlessly accumulate the physical metal at these severely discounted, artificially suppressed prices. They clearly understand that the paper market manipulation is nothing more than a temporary manufactured illusion, and they ruthlessly leverage this orchestrated panic to position themselves for the inevitable explosive snapback. If you require absolute proof that this exact 6-step sequence is playing out right in front of our eyes today, we only need to look at undeniable historical precedent, because this exact same merciless dynamic has played out repeatedly over the last 50 years of financial history. Let us travel back to the tumultuous economic environment of the mid-1970s. In 1974, silver experienced a massive euphoric run-up driven heavily by rampant inflationary fears, an oil embargo, and a total loss of confidence in the fiat currency system following the abandonment of the gold standard. But then, a severe biting recession hit the global economy. Liquidity completely dried up across the banking sector, and silver prices violently crashed by over 50% in a matter of months. The retail investors who had enthusiastically bought at the absolute top were utterly decimated, paralyzed by the speed of the drop, and they sold their hard-earned positions in absolute panic, vowing never to touch precious metals again. But the smart money, the seasoned insiders who understood the macro conditions, knew that the underlying structural inflation had not been magically resolved by the Federal Reserve. They deeply understood the severe opportunity cost of holding rapidly depreciating paper dollars, and they quietly, methodically accumulated massive hoards of physical silver during the absolute darkest days of the crash. What followed that period of mechanical suppression was the historic, legendary run of the late 1970s, a spectacular bull market culminating in the 1980 peak, where silver famously reached $50 an ounce, delivering an unthinkable, life-changing return for those rare individuals who had the iron fortitude to hold through the pain. We saw this exact same deceptive pattern repeat itself with terrifying precision during the great financial crisis of 2008. As the subprime housing market abruptly collapsed and the entire global banking system completely froze in a state of sheer terror, unprecedented margin calls triggered massive, indiscriminate liquidations across absolutely all asset classes simultaneously. Silver plummeted violently from $21 down to under $9 in a matter of just a few terrifying months. The mainstream financial media aggressively declared precious metals completely dead, confidently asserting that physical cash was the only remaining safe haven in a crumbling world. Retail investors, drowning in a sea of fear and regret, dumped their physical silver at the exact wrong moment, locking in devastating losses. Yet, behind the scenes, hidden from the public eye, the structural bid for physical metal remained incredibly strong and profoundly resilient. The physical market was completely disconnected from the crashing paper spot price, with premiums on physical coins and bullion bars skyrocketing to unprecedented levels because actual physical metal was virtually impossible to source. Once the forced institutional liquidations finally ended and the Federal Reserve inevitably initiated their massive quantitative easing programs to bail out the banking system, the fundamental, undeniable reality of silver's extreme scarcity violently reasserted itself. Those educated investors who truly understood the 6-step mechanical process and bravely chose to accumulate physical ounces during the absolute depths of the 2008 crash were handsomely rewarded with a spectacular, unstoppable rally that drove silver back up to nearly $50 an ounce by the year 2011. This is the historically proven, undeniable sequence. A temporary, liquidity-driven, mechanically induced crash that brutally shakes out the weak, uneducated hands, followed immediately by an explosive, structurally driven, fundamentally backed rally to massive new all-time highs. Now, armed with this historical context, we must intensely turn our attention to the present setup because the specific macro conditions converging as we look toward the year 2026 are exhibiting extreme, unprecedented indicators that completely dwarf the crises of both the 1970s and 2008. We are currently facing a terrifying sovereign debt crisis of a magnitude never before witnessed in human history, coupled directly with sticky, deeply structural inflation, a fracturing geopolitical landscape, and a relentless global push toward massive, unsustainable government deficit spending. At the exact same time, the fundamental underlying supply and demand dynamics for physical silver have literally never been more aggressively bullish. Global industrial demand, particularly emanating from the rapidly expanding solar panel manufacturing sector, the electric vehicle revolution, and advanced military applications, is completely, fundamentally inelastic. These massive corporate manufacturers must acquire physical silver to keep their assembly lines running, regardless of what the quoted paper price is. And because of this relentless consumption, we are currently running consecutive multi-hundred million ounce physical supply deficits year after year. Above ground, easily accessible stockpiles of silver are being rapidly depleted at a dramatic, alarming rate that the mining industry simply cannot replace. Yet, despite these extreme, undeniably bullish physical fundamentals, the quoted paper price of silver has recently suffered a highly frustrating, deeply confusing drop. Why? Because we are currently trapped squarely in the middle of the exact same mechanical liquidity squeeze, the exact same margin call-driven shakeout that we witnessed in the 1970s and in 2008. Institutional margin calls and relentless algorithmic short selling have temporarily created a devastating illusion of abundant supply in the fraudulent paper market. But this fragile illusion is rapidly breaking down, and to truly understand how this current scenario ultimately resolves itself, you must thoroughly understand the four distinct phases of market recovery that mathematically always follow these brutal mechanical shakeouts. Phase 1 is the violent liquidation event itself, the sharp, terrifying vertical drop where desperate margin calls force the indiscriminate selling of millions of paper contracts, completely decoupling the quoted spot price from the actual physical reality of the global market. This is the agonizing phase of maximum public fear, where the vast majority of uninformed retail investors make the tragic, irreversible mistake of selling their physical assets at the absolute bottom. Phase 2 is the grueling bottoming process, a prolonged period of immense, confusing volatility and utterly exhausting sideways price action. The market maliciously chops sideways for months, deliberately creating false breakouts that trap eager buyers, followed immediately by false breakdowns that terrify remaining holders. This psychologically draining phase is explicitly designed to exhaust the patience of the remaining weak hands, continuously grinding down their resolve until they finally give up in absolute disgust and reallocate their precious capital into whatever overvalued tech stock or mainstream financial media narrative is currently being hyped on television. It is precisely during this agonizing phase 2 that the smart money quietly, methodically steps in to aggressively absorb the available physical supply, building massive, generationally significant positions without triggering a noticeable price spike. Phase 3 is the glorious structural realization. This is the precise, explosive moment when the fraudulent paper market manipulation can no longer contain the overwhelming physical reality of the massive supply deficits. The massive structural buyers, having finally secured their required physical positions, entirely stop suppressing the paper price. Simultaneously, the exact same automated trading algorithms that were relentlessly shorting the market suddenly and violently flip their positioning, triggering a massive, unstoppable short squeeze that rips the face off of the institutional bears. The price begins to rise incredibly rapidly, violently breaking through critical technical resistance levels with explosive, undeniable momentum. This is the exhilarating phase where the severe opportunity cost of not holding a massive physical silver position becomes painfully, agonizingly obvious to the broader financial market. Finally, phase 4 is the spectacular public mania, the breathtaking blow-off top where the clueless mainstream financial media suddenly discovers the critical global silver shortage and millions of terrified retail investors rush blindly back into the market in a desperate, frantic panic to buy physical metal at significantly exponentially higher prices, ultimately providing the necessary exit liquidity for the smart money that wisely accumulated their massive positions during the dark days of Phase 2. My decades of rigorous, uncompromising market analysis point to one undeniable, absolutely critical reality that you must comprehend today. We are currently rapidly transitioning out of the exhausting Phase 2 bottoming process and are standing directly on the very precipice of the explosive Phase 3 structural realization. The mechanical suppression machinery is visibly failing under the immense weight of the physical deficits. The extreme physical tightness in the global vaults is becoming mathematically impossible to hide from the market, and the relentless structural bid from desperate industrial users and forward-thinking sovereign entities is growing significantly more aggressive by the literal day. This is the absolute climax of the current macro cycle, the precise, fleeting moment where the smart institutional money has completely finished their quiet accumulation and is actively preparing to step back and let the free market run wild. The brief transition period from Phase 2 to Phase 3 is historically the most profitable, life-altering window in the entire precious metals cycle, but it is also brutally, unforgivingly the shortest. Once Phase 3 truly ignites and the short squeeze begins, the upward price action will be so incredibly dramatic, so breathtakingly rapid, and so completely unstoppable that those investors who are not already fully positioned with physical metal will be left entirely behind in the dust, watching from the sidelines in absolute heart-wrenching regret. You absolutely cannot wait for mainstream media confirmation to act, because by the time the smiling financial anchors on television are breathlessly talking about the historic silver squeeze, the absolute easiest, safest, and largest financial gains will have already been made by those who had the foresight to act today. This is the ultimate defining test of your financial conviction. You have painfully endured the trial, you have helplessly witnessed the terrifying mechanical drop, and now, armed with this comprehensive analysis, you have the exact historical blueprint required to understand exactly why it happened and exactly what comes next. The silver market is not fundamentally broken. It is functioning exactly, precisely as it always does during these massive generational wealth transfers. The heavily leveraged institutions desperately want you to remain completely paralyzed by the daily noise. They actively want you to surrender your valuable physical assets at a massive discount so they can cheaply cover their underwater paper shorts and selfishly ride the impending structural wave to massive new all-time highs themselves. But you now definitively possess the critical insider knowledge required to completely see through their transparent manipulative illusion. You clearly understand the deteriorating macro conditions. You fully understand the completely inelastic industrial demand. And you deeply understand the undeniable historical precedent of the 1970s and 2008. The stark choice currently standing before you is whether you will foolishly allow blind fear to dictate your financial actions and tragically join the pathetic ranks of the emotional retail investors who mathematically always sell at the exact wrong time, or whether you will courageously adopt the calculating mindset of the smart money, intelligently leveraging this temporary, artificial mechanical suppression to your absolute ultimate advantage. This requires a profound, fundamental shift in your entire investment perspective. You must immediately stop looking at the manipulated daily spot price as a legitimate measure of silver's true fundamental value and start correctly looking at it as a highly useful indicator of the current phase of the institutional manipulation cycle. When the quoted paper price violently drops in the absolute face of massive, undeniable physical supply deficits, it is absolutely not a signal to panic and sell. It is a blaring, flashing neon signal to aggressively, relentlessly accumulate as much physical metal as humanly possible. Every single physical ounce of silver you manage to acquire at these ridiculously, artificially suppressed price levels is a direct, undeniable claim on the massive future wealth transfer that will inevitably occur the moment Phase 3 definitively takes hold of the market. The massive industrial giants simply cannot run their critical manufacturing factories on empty paper contracts. The entire promised global green energy revolution absolutely cannot be built on fragile algorithmic illusions. The fundamental demand for physical, tangible metal is absolute, and the geological supply is strictly finite. This is a cold, hard mathematical certainty that simply cannot be magically altered, printed away, or wished out of existence by dovish Federal Reserve monetary policy or corrupt Wall Street paper manipulation. As we move significantly deeper into this incredibly volatile decade, the terrifying convergence of the global sovereign debt crisis, sticky structural inflation, and massive unyielding industrial deficits will inevitably create a perfect, unstoppable macroeconomic storm for tangible precious metals. Silver, possessing the completely unique dual characteristic of being both a historically proven monetary metal and an absolutely critical, irreplaceable industrial commodity, will undoubtedly be the ultimate premier beneficiary of this unprecedented macro environment. But to actually reap the massive, life-changing rewards of this historically unprecedented setup, you absolutely must survive this current psychological trial. You must actively ignore the false mainstream narrative, bravely absorb the terrifying daily volatility, and fiercely maintain your unwavering focus on the underlying structural reality of the market. You must aggressively act before the paper market definitively breaks, before the fragile illusion completely shatters and the physical price violently resets upward to match its true, unsuppressed fundamental value. The extremely narrow window of opportunity to acquire physical silver at these heavily discounted, manipulated prices is closing incredibly rapidly. The smart institutional money clearly knows this, which is exactly why they are currently draining the global commodity depositories at a truly record-breaking historic pace. They are frantically preparing for the imminent transition to Phase 3, and you absolutely must do the exact same thing if you want to protect your wealth. Do not let the temporary, manufactured pain of the recent mechanical price drop foolishly blind you to the massive, generationally significant opportunity that currently lies directly ahead of you. Use this exclusive macro knowledge to powerfully empower your investment decisions today. Reallocate your capital strategically and aggressively, taking full advantage of the manufactured panic in the broader financial markets to permanently secure your physical silver position. Always remember the critical historical lessons of the 1970s and the crash of 2008. Those rare, educated investors who truly understood the mechanical explanation of the drop and bravely accumulated physical assets during the absolute deepest, darkest moments of public despair were the exact same individuals who achieved massive generational wealth when the macro cycle inevitably turned in their favor. We are currently standing on the very verge of a massive structural rally that will completely eclipse absolutely anything we have ever witnessed in modern financial history. The brutal mechanics of the engineered drop have played out perfectly according to the historical script. The exhausting bottoming process is rapidly nearing its final completion, and the explosive, unstoppable realization phase is truly imminent. The time for fearful hesitation has completely passed. The time for decisive, highly informed, aggressive action is right now, today. You have been explicitly given the historical blueprint. You have been clearly shown the undeniable mathematical proof, and you have been thoroughly warned about the deceptive psychological traps deliberately designed by the institutions to separate you from your rightful wealth. Now, the ultimate responsibility rests entirely and squarely on your own shoulders. Will you tragically choose to be a helpless victim of this orchestrated mechanical shakeout? Or will you courageously choose to be a massive financial beneficiary of the greatest, most explosive structural short squeeze of our entire lifetime? The market is actively testing your resolve right now, demanding to know if you possess the true conviction to hold strong when the daily noise is absolutely deafening. Stand firm in your fundamental knowledge. Correctly recognize the institutional manipulation for exactly what it is. Aggressively accumulate the physical metal while the fraudulent paper price remains artificially, temporarily low, and fiercely prepare yourself for the dramatic, entirely inevitable upward revaluation that is rapidly approaching. Patience and strategic accumulation during this transition will position you to benefit fully from what is coming. Silver holders who understand the sequence and act decisively now will participate in the most significant structural rally of their lifetime.